one thing I really wanted to touch on there was something that I haven't asked you guys before, and that's quite interested me, is that you set your expected rate or your conservative rate at around 6%. And that's interesting that you've set that target, because I think this is a really important rule in investing, particularly for me, because I've set my rule at about 4%. And when I first started all YouTube and everything like that, I was putting in dividend investing and things and putting it all into dividend stocks. And my comments were full of people saying to me, you're not an investor, you're a terrible investor if you can't earn 30, 40, maybe even 50% on your money. And I was thinking
but then you stopped making videos, so I've stopped writing in your comment sections now.
But I was thinking to myself, that's a lot. That seems like a lot. You know, the best investors in the world only earn 30% a year, and they even attribute that a lot to luck. And so I think it's very important, and I'd love to hear some people in the comments who might be able to tell us what they think their expected rate is, because a lot of people set it at 10%, don't they? Because that's the historical average of the S&P 500. I think that's very high. And personally, I went to my compound interest calculator. I figured out how much money I'm going to need by the time I'm 67, or if I wanted to retire earlier, I would figure out that amount. I think it was around 450,000 initially. It's probably a little bit higher than that now. But I set myself to compound at a rate of 4% and figured out a path to get there. And that's why now, when we're seeing rates at around 5%, coming on to 6%, and my mortgage is now 5%, my risk-free rate is covered now. So I should be able to, by putting into my mortgage and putting into basic savings accounts, which is unbelievable to think of now, I will eventually reach my financial freedom number. You know, I'll reach that goal, and I've set that at 4%. So I wonder, and I'd like to hear from people in the comments as well, what they think their number is, what they expect as a return. Because it used to be, honest to God, it used to be like, you need to double your money every single year. If you double your money every single year, you'll be a millionaire in a couple of years. And I was thinking to myself, that is a tough old deal. And then you see Tesla going up. And that was when people were, I think that was when people were really thinking this thing. But I wonder what it is now. I wonder what people are expecting from the market now. And I'd love to hear that in the comments and on Instagram if anyone wants to message me or anything like that.
So I think Steve is dead right. That number has to be bigger than 4. Otherwise, there is a real question of, if you're aiming for 4%, why aren't you taking the easiest route to 4% available, which is, I mean, even if you don't think it's gilts, even if you think it's like a 2-year saving or something like that, that'll get you above 4%. Something along those lines has to be a more straightforward thing. And 4%, to Steve's point with gilts nowadays, is not nothing. I mean, it's not so very long ago that people were going mad when Realty Income's yield went through 4%. They thought, this is great, this is an absolute steal here. There is a difference between a gilt and Realty Income, obviously, in that Realty Income's dividend might go up and the yield on a gilt when you buy it won't. But, you know, 4%, we're now talking about what was previously the kind of thing that dividend investors were thinking is quite a high yield when rates were kind of right down at whatever they were, 0.5% negative in real terms. You get the general idea.
Yeah, I'd like to think that dividend investors, you know, if we're really going to, there's a couple of good ones out there at the minute on there that are really pushing some big stocks. I'd like to think that these dividend investors take into account capital appreciation at the same time. But in my personal idea was that if I could find a base rate of, say, a 4% dividend yield, I would still get to my goal, and it was quite a low ceiling to break through. And if I did any better than that, it just means I'm getting there quicker. And that's kind of how I saw it, and it's how I still see it now, even though it's a bit choppy at the moment. It's a lot less clear, especially now I've got to take money from certain places and put it into other places. But if I can keep going and keep working, I will be there at 4%. And I suppose the reason why we get into stocks after that is because of the possible premium that you're going to get from taking the risk.
Yeah, there's nothing like future-proofing a bit of dignity in retirement by setting your expectations low. I think that's fair enough. You know, I mean, if you think you need X amount of money to retire or to be happy or to be comfortable when you retire, and you can get there by only getting 4%, well, that gives you an awful lot of choice in what you invest in, doesn't it? So, whereas, you know, everybody wants to double their money. Yeah, if you want to double your money, you've got to be scouring the latest penny stocks. You've got to be, you know, it really cuts you down to just simple trying to find momentum anywhere you can find it. Whereas if you're only looking for 4% at the moment, you can say, hey, do you know what? I'll bang 50% of my portfolio in gilts or 80% of my portfolio in gilts because that'll get me 4%, and then, you know, I'll try and find some alpha in the market somewhere. You know, that's fine. When it gets to 6% or 6.5% or whatever you've got your set, Steve, it becomes a little bit trickier because you have to be a little bit careful in what you buy. But it's one of the beauties of the dividend portfolio as well, though, if that's what you're into. If you're into buying income, you know, you might get 1 or 2% out of your portfolio, and you've only got to find 4% of capital appreciation. And in the American markets, there's been a lot of companies that have achieved 4% capital appreciation over that period of time. So yeah, I'm in favour of setting expectations low, especially if it makes you contribute more to these kind of things, because you know, that's key. Go on, Steve. Sorry, I feel like I'm to fire.
Is exactly the thing I was going to say. I mean, once you've got your stuff banged in boring old gilts or something, next job is stop worrying about that. The price will go where it goes. Don't sell them again. Go out and make some more money, which is pretty much exactly, as I understand it, what Paul's doing.
That's the idea. I mean, the main thing that I've taken away from that is that Steve D approaches the idea of dividend investing with the same way an old man would look at a gay pair in the street and go, well, if it's okay for them, it's okay for them. Fair play to you guys. That was the way I saw it. I went, all right. It's dividend investing. If it's what you like, you know, as long as you don't bother me with it, I'm okay.
That's strictly my old Yorkshire attitude, that you can do it, but don't bring it to my door. I don't want anyone knocking on there telling me the virtues of dividend investing.